The CPI data came out on 10th of February has shown the highest inflation rate since 1982. And there is no sign of slowing down at the moment. So in conventional wisdom, people will tell you cash is trash when inflation is high. Well, this is because inflation eats away your purchasing power day by day. And the same loaf of bread that costs you $2 1 year ago may now cost you $2.2. And in other words, the dollar is losing value fast, and you should either spend it or invest it somewhere. So when I suggested in my last video to hold more cash in the current situation, a lot of people are puzzled. Why did I suggest so? Isn't it contradicting the conventional wisdom? Well, you see, cash is trash up till now because all governments have been printing out free cash for the past 2 years. There is no shortage of cash and people are feeling rich and spending like crazy. And this is part of the reason that we have high inflation now. And the stock market is even crazier. It is the most rapid growing market we have ever seen since the dot-com bubble. And anyone who has invested in the stock market for the past 2 years have significant gains. But now we need to worry more about what comes after high inflation. Because the Fed and the Congress will fight against inflation. And no party will go on forever. Same with high inflation. The Congress has taken a stand to try to stop fiscal stimulus. It blocks literally everything the president wants to spend. And then the Fed also stops monetary stimulus and eventually will go into monetary tightening. So all of these means there will be less money on the sidelines to invest into stocks and real estate. And people who have heavily leveraged, meaning have lots of cheap debts because of zero interest rate, will also have to deleverage due to the looming interest rate hikes. So they will have to start to sell assets to repay their debt. Now, the US debt to GDP ratio is at the highest since 1929, the Great Depression. End of 2021, the total US debt was at $29.6 trillion. It's 124% of the total US GDP. And now, 2 months into 2022, the total US debt is now more than $30 trillion and 125% of total US GDP. So once the major deleveraging starts, the debt spiral, or more dramatically, the debt spiral will start. You will see defaults and money evaporate fast. And people would want to get rid of their over-leveraged assets cheaply to pay back debts. And this translates to the stock market and real estate market crash, also entering into a recession. Okay, that is just a scenario I'm painting here. It doesn't have to be this bad because it mostly depends on the Fed's capability of smoothly lowering down the inflation and not causing a recession. If the Fed tightens too much too fast, the inflation will come down, so as the economy. The high likelihood is we go into a recession. But if the Fed tightens too little too slowly, the chances are high inflation will continue, and then the Fed would have to tighten more aggressively, and that would also cause a recession. So the only scenario that we will have a smooth sail is if the Fed can accurately balance this situation. Not to over-tighten, neither under-tighten. Well, I guess that's a hell of a job. So for us small investors, we need to ask ourselves, do we believe the Fed's ability to control inflation smoothly and not causing recession? Basically, you need to ask yourself, do you have faith in the Fed? Because if you do, then stay calm in the market and take the opportunity to buy the dip. But if you don't, then you probably should raise more cash to prepare for the recession. This is not financial advice, I'm just laying out the scenarios so you can decide for yourself. So cash is not always trash. It is trash when we are entering in an economic expansion. But during the late stage of economic expansion, cash could be your lifeboat for the coming economic contraction times. You see, the market and the economy goes in cycles. What comes after the economic expansion is usually the peak of expansion, where the economy reaches a saturation point and the maximum growth is attained. Prices are at their highest level. This stage marks the reversal point in the trend of economic growth. Consumers tend to restructure their debts and budgets at this point, and after the peak follows the beginning of a recession. The demand for goods and services starts to decline rapidly and steadily in this phase. Producers do not notice the decrease in demand instantly and go on producing, which creates a situation of excess supply in the market. Prices tend to fall, and all positive economic indicators such as income, output, wages start to fall as well. And during the recession, the prices will continue to fall and the unemployment rate will rise. The length of a recession depends on lots of factors. Some might only last a few quarters, others might last a couple of years. Nevertheless, it will hit a bottom, a trough, and things will start to turn around. At this stage, the debt to GDP ratio is often the lowest, and the assets market is often at the lowest price too. So if you want to capture the macroeconomic shift and the next economic expansion cycle, then you should invest when the economy is the worst, because everything is cheapest at that time. And what comes next is the recovery stage. And this will mark the starting of another economic expansion. And then the circle keeps going on and on. So another question you should also ask yourself is, which stage of the economic cycle do you think we're in right now? Are we approaching the peak of expansion, or do you think we are still in the middle of an expansion? Please leave a comment down below to let me know what you think, and smash the like button if you find this information helpful. I hope you all stay safe in the market, and I will see you in my next video. Bye!